Hi, I'm Michael Cox, President of Coastal Bay Wealth Management. On today's video, we have a special guest. Mr. Michael Bertha is a certified public accountant and the managing partner of Coastal Bay Tax and Consulting. Welcome, Michael.
Thank you for having me.
We are going to be breaking down how retirement benefits are impacted by taxes and steps that you can take now to potentially minimize taxes in retirement. Most people focus on how much they save for retirement, but the better question might be is how much money will you actually keep after taxes? So let's start here. Why should someone thinking about retirement today be focused on taxes at all?
Because for many individuals, taxes become one of the largest ongoing expenses. A significant portion of retirement savings is often held in tax-deferred accounts like 401ks or traditional IRAs. When those funds are withdrawn, they are typically taxed as ordinary income. If you do not plan for that, the difference between what you have saved and what you can actually spend can be meaningful. It also impacts things beyond income, like Medicare cost and how Social Security is taxed.
So this is not just how much you have saved. It's about how efficiently you can turn that into income after taxes. That shift in thinking is where a lot of people start to see things differently. Let's break this down by stage of life. If someone is early in their career, what are the most impactful steps that they can take right now?
At that stage, flexibility is your biggest advantage. One of the most effective things you can do is build tax diversification. That means having assets across different tax categories, such as taxable accounts, tax-deferred accounts, and tax-advantaged accounts when appropriate. This creates options later when you're deciding where to pull income from. Another important but often overlooked area is how investments are managed in those taxable accounts. Being mindful of capital gains, limiting unnecessary turnover, and focusing on tax efficiency can have a significant long-term impact. The earlier you start thinking this way, the more flexibility you create later.
That flexibility is key. It is what gives you control in retirement instead of being forced into one type of tax treatment. Now, as people move into their 40s, 50s, or early 60s, what starts to change?
This is when planning becomes more proactive. At this stage, it becomes important to understand your potential tax bracket in retirement. If there's a chance it could be similar or even higher than today, strategies like Roth conversions may be worth evaluating. That involves recognizing income now at a known rate to reduce future taxable distributions. There's also something we call planning windows. For example, the years between when someone retires and when required minimum distributions begin can create opportunities to make more intentional tax decisions. You also begin thinking more about asset location. Some investments are better suited for tax-deferred accounts, while others may be more appropriate in taxable accounts, depending on how they are taxed.
So at this stage, it becomes less about saving and more about being strategic with timing and structure. That is where you can really start to shape future outcomes. And what about someone who is right up against retirement or already there?
At that point, coordination becomes critical. The order in which you take withdrawals can significantly affect your overall tax outcome. For example, relying too heavily on one type of account can push you into a higher tax situation, while a more balanced approach across account types may help manage that. There are also ripple effects to consider, like how income impacts Medicare premiums or Social Security taxation. This is where having a structured withdrawal strategy becomes very important.
So that is where a lot of people get caught off guard. They've done a great job saving, but without a withdrawal strategy, they're not being as efficient as they could be. Let's take it a step further. What are some of the more advanced strategies people may not be thinking about?
Yes. Depending on the situation, tax loss harvesting and taxable accounts can help offset gains and reduce current tax liability. Asset location is another key concept. placing certain types of investments in accounts where they are taxed more favorably. For individuals who are charitably inclined, qualified charitable distributions from traditional IRAs can be a more tax-efficient way to give. And the timing of larger financial decisions, like selling a business or realizing gains, can have a meaningful impact on your overall tax picture. These strategies are more nuanced, but they highlight how much control can come from planning ahead.
And that really reinforces the idea that taxes are not just something to react to. They are something that we can plan around if we are proactive. When you take a step back, this is not about trying to eliminate taxes entirely. It is about being intentional with how and when you pay them. And that can be a meaningful impact on your long-term financial outcome. Michael, I want to thank you for joining us today. The decisions that you make today shape everything that comes next. If you want to understand how this applies to your situation, contact us at Coastal Bay Wealth Management. Your future is not something to leave to chance. It's something to plan for with clarity and confidence. Thank you for watching.